Brian, I'll just start with you. You think we're going to see a whole lot more of this to come?
Oh, definitely. Once the Fed opened up the corporate bond market at the end of March by stating their intention to buy corporate bonds, we saw a near record flow of money almost double. So there's a tremendous amount of money going into companies. I think that's a short-term positive and a longer-term negative.
How much of a negative? Because love them or hate them, stock buybacks were an important part of the last bull rally, and it sounds like we're not going to have them this time around.
Almost every time I've been on with you the last 7, 8 years, I've talked about debt money going for stock buybacks. In the next cycle, there's so much debt going on, I think we're going to have to focus on debt buybacks. And that's probably a negative for economic growth. I think it's going to be a slow economic recovery based on that.
Mike, how would you evaluate the trading ranges for the S&P, the strength of this recovery, the letter shape it might take, given all of this?
Obviously, the market with the 28% rally, I think, in less than a month's time to Friday's highs, did suggest that the market felt as if the capital markets were refreshed by the Fed's actions and the openness to new corporate bond issuance. There was not going to be a big kind of meltdown on the corporate bond side. That has helped bolster the idea that the companies that we already knew were well positioned before, which drive the S&P 500, have remained so. They've remained in favor, the big growth companies. I don't know exactly how it's going to shake out, though, with this equity raise going on in many companies. Obviously, it's bolstering the aggregate balance sheet, and it's diluting some parts of the market. I just am unsure exactly how much to extrapolate that into what behavior is going to look like in the coming years and whether, in fact, companies are going to deleverage.
Right. Brian, I think that's an interesting question, too. Can they just stay with permanently higher debt levels, or how much urgency will companies have to repay debt instead of just leaving it hanging there as kind of an analogy for the whole country?
If they stay with higher debt levels, their profitability will be less. And keep in mind that one of the new bondholders is the Fed. They're putting taxpayer money to work in corporate capital structures. So traditionally, when that's happened, like with AIG and GM, the Fed insists on getting taxpayer money back first before a company can buy stock, and that probably takes years into the next cycle before that happens for most companies.
I just wonder if the Fed realizes that could hurt the recovery more than help. Maybe they wouldn't demand it back.
I think they're taking it one step at a time.
Yeah, and trying to learn, there's going to be obviously a lot of pressure to get that taxpayer money back, but it seems like we're darned if we do and darned if we don't, so to speak. Mike, final thought here. I guess, like Brian said, the takeaway is we can view these as a short-term positive and just wonder about the hangover. Yeah,
without a doubt. I would sort of caution to go back in 2009. You also had a lot of equity raises. You also had the same kind of dynamic, no more stock buybacks. The market did okay because it could look ahead to a further kind of growth cycle. But the sectors that raised all that equity were not really the leaders in that next bull market, meaning banks.
Great point. And another reason to watch who's up to what this time around. Thank you both. Mike Santoli, Brian Reynolds. Great discussion. Really appreciate it.